As many of us know, the Fed recently raised their interest rates by 0.25%. This brings the federal fund rate to 5%, which is 5% higher than only a year ago. In this video, I will be covering everything that happened since the meeting on March 22nd, as well as what to expect for the next coming months. Be sure to stick around to the end of the video where I will give you advice on how to use this information to benefit your bank account.
By far the best investment you can make is in yourself.
With interest rates higher than they ever been since 2008, many people speculate a recession is coming for the economy. Goldman Sachs just released a prediction that there is a 35% chance of a recession that will occur within the next coming year. This is 10% higher than their prediction only a month ago. Now, why is this? In the aftermath of the SVB collapse, there is no doubt that the everyday consumer is starting to lose trust in the banking system. Notably, 4 major banks' share prices fell immediately after the crash, including JP Morgan Chase, Wells Fargo, Bank of America, and Citibank. Now, Deutsche Bank is looking like the next one to have turmoil due to their recent failure in the federal funds stress test. This highlighted the weaknesses in the firm's data capability over the years and the recent scandals. It definitely doesn't look promising. Seeing bank shares fall causes panic, and the depositors will pull money out from their local banks to avoid being caught in another bank collapse. This is known as a bank run and could possibly be followed by a collapse in the entire financial system, as seen in 2008. Other reasons that hint towards a recession is the rise in unemployment from 3.4 to 3.6% over the last month, which doesn't seem like a lot, but considering that nearly 165 million Americans are in the working force. That means that close to 3 million Americans lost their job all in the past month. This unemployment rate is expected to rise to nearly 4% by the end of next year, with no government help like in 2020. Amazon says they plan to lay off 18,000 employees later on this year, on top of the 10,000 they already laid off in 2022. The reasoning is that for a lot of these tech companies, their revenue is based on consumer spending and advertisement. With interest rates so high, the average consumer can't spend much money on items, and businesses can't spend much money on advertisement. If that wasn't enough, the Fed came out and said interest rates will need to raise to 5.25% and stay there for the remainder of 2023. But the markets are pricing otherwise. In fact, the markets are predicting that by the next FOMC meeting, there will actually be a pause. And they say the Fed pivot will occur no later than July of this year. Now, these two predictions couldn't be farther apart. So come July, there may be a lot of turbulence in the markets if inflation hasn't gone down as fast as the Fed wants it to. A better understanding of this will occur on April 12th, when the March inflation report comes out. This will allow the Fed to determine whether interest rates need to be hiked or paused. I will make another video covering that on that date. Over the next coming months, the Fed will have to choose between economic depression or a period of hyperinflation, which is inflation during a recession. I personally believe stagflation will occur in the next couple months, which is when inflation hovers around a certain range. I believe it to be the 5% range, which is why the markets might be wrong about cutting rates in July. My advice to you would be don't panic if you see the market prices go down. In fact, save a reservoir of money to buy when there's blood in the streets and the economy is collapsing. If there's anything to take away from this, it's that the economy will suffer over the next couple months, but will recover. Statistically speaking, after a recession happens, the average bull run lasts about 3.8 years. I will make a video next week on what stocks I think will propel your portfolio in the next coming months, and how you could set yourself up for a better future. Be sure to like and subscribe to stay updated on how I could help you retire early. Take care.